Hi, everybody. Gina here with your weekly market update. We are about to close out the first month of the year, and so far it has been pretty great for the markets. As of the close of business last week, the Dow was up 2.5%, the NASDAQ was up about 11%, and the S&P was up roughly 6%. So here is hoping that we can continue this ride throughout the rest of the year. We have a busy week ahead of us. The Federal Reserve's first meeting is scheduled for tomorrow, and it appears that they are set to slow the pace of their rate hike to 25 basis points, which is what we anticipate, what the markets have already anticipated and built in. And it is probably too soon for them to send any definitive slowdown signs and signals, even though it does appear that inflation has peaked or is peaking. But the challenge for them and for the Federal Reserve is that to keep that aggressive anti-inflation rhetoric going while and even as they slow the pace of that rate hike. So we will certainly be looking forward to hearing the vernacular out of the Fed tomorrow and trying to read between the lines of exactly what they say. And so stay tuned. Also, it looks like because of the great month we had in January, we may potentially be breaking through that 200-day moving average resistance line that we often reference and that Cynthia refers to in her charting in these videos. And we will need more certainty and time on this before making any major moves, but it is definitely trending in a positive direction. So stay tuned. But I do think that offers a really good opportunity to just real briefly take a step back and reiterate the importance of how and why we look so closely at these chartings and the fundamental analysis. Obviously, that 200-day moving average is one of many tools that we use and look at to make our active money management decisions. And as most of you know, we are active money managers. That's our investment strategy and philosophy, which means we really try to take advantage and capitalize on the market movement in both directions. Whereas a passive money manager would come up with a asset allocation based off of age, risk profile, etc. And for all intensive purposes, kind of buy and hold and stick to that asset allocation sort of regardless of what's happening with the market. And that's just not the strategy that we follow. Can it work? Certainly in normal, regular, just slow and steady bull market runs, that's a fine approach. But in times of volatility in both directions, that active money management really becomes quite crucial. And this was demonstrated pretty evidently in the early 2000s. If you looked at putting your money in the S&P 500, late 1999 or leading into 2000, if you looked at just roughly a decade later, had you turned a blind eye and not done anything with that money, you would be virtually flat. And that's because of the volatility and not mitigating losses or capitalizing on growth. Now, obviously, past performance is no indication of future results, but if we look back at that time, the active management and approach that we took during that time, we actually were able to make money in that lost decade. And it's just because of those decisions that I referenced. So what that means right now is that with this volatility, that active management becomes more important than ever, in our opinion. And I think part of that reason and why we believe it works is not only the charting, but mostly because you hire us to take the emotions out of those investment decisions and really look at it from a logical perspective. The two main emotions that tend to impact the individual investor who's trying to do it themselves is fear and greed. And so hopefully we take those out of the equation. We look at it from a logical standpoint, and with the active management, what you saw us do last year was mitigate those potential losses by getting defensive, raising cash. We don't feel that you need to go down with the ship. And now what we're hoping for and looking for is being able to capitalize on the market growth opportunities that hopefully will be coming very soon, and being able to get that cash that's on the sideline back into the market and capitalizing on those opportunities. But to do that and to take the emotions out of it requires a tremendous amount of patience, and we're never going to have perfect timing, but certainly unemotional timing in making those decisions. And so that timing and patience really is key for us in moving forward, and has been key and critical for us leading up until this point. And so we just ask that you bear with us as we get through these next few months in this uncertain time. We appreciate you bearing with us and being patient thus far, and letting us do what we do best. And of course, as always, we will keep you posted on our thoughts and any major movements that we're anticipating. But until then, I hope you have a great week, and we'll be in touch and talk to you next week. Take care.